Hey there, this is Jorge Montoya with the Montoya Mortgage Team, and today we're going to talk about VA loans. So let's jump right in. So first, what is a VA loan? Well, a VA loan is a government-backed loan by the United States Department of Veterans Affairs. It's a true zero money down program. And when I say zero money down, they mean it. If the home price is $500,000, you can borrow $500,000. So it is truly a no money down program. In order to get a VA loan, you must be an eligible veteran who has available home loan entitlement, which we'll talk about further in a few slides. Now, VA has a zero down payment requirement as long as you have full entitlement. Generally, $36,000 represents full entitlement, which we'll talk about here in a few moments. Another thing that makes VA loans attractive is that gifts are allowed. However, they have to come from an eligible donor, someone that has no affiliation with the builder, the developer, the real estate agent, or any other interested party to the transaction. So since the loan has no down payment requirement, if the veteran received a gift per se for closing costs, 100% allowed, as long as it's someone that has no affiliation with the transaction. Now, VA loans can be combined with down payment assistance, which is excellent because with the combination of the 100% financing the VA offers, and then in the state that you end up purchasing, should there be a down payment assistance program, VA does allow us to combine these, which then would give you the option for a true zero out-of-pocket loan, which is phenomenal. Additionally, there are seller contributions allowed, which is a very, very common thing, at least in our current marketplace. However, when it comes to VA loans, there are certain fees that a veteran can never pay for. So some of these fees are attorney fees as a benefit to the lender, the mortgage broker or agent commission, a finder fee, a referral fee, a prepayment penalty, natural hazard disclosure report fee, and a HUD FHA inspection fee for builders. Now, one thing that you'll notice is that under the mortgage agent and under mortgage broker or agent commission, I did circle exception bases. Now, if in a negotiation a veteran agreed to pay for these things, then sometimes a lending institution will consider the veteran allowing the veteran to pay these things if that's something that they agreed to, but it is on an exception basis. When it comes to credit scores, something that's really good and many people may not know is that there's generally no credit score requirement. So if you have no credit scores, that's okay per VA's guidelines. However, that may not be okay per your lending institution's guidelines. So for example, with the company I work with, in order to get a VA loan, they're going to require that we have a 540 credit scores. So depending on the lending institution you're with, it could be that, it could be lower, it could be higher. So this is something that does vary from lending institution to lending institution. When it comes to overall credit activity, VA does allow us to pay off accounts in order to qualify. So let's say if there was a credit card or an installment payment or an auto loan that the veteran wanted to pay at the time of closing in order to qualify for a little bit more house, VA does allow you to do that, which is great. VA does not require collections be paid off. However, it is a factor that is considered in the approval. If it's like a one-off situation and something that's not consistently happening, then VA generally will disregard those collections. But when you have multiple collections and it just seems more like a pattern, then a VA underwriter may want more information on the circumstances of what led to that or an explanation. Now, if a collection account reports a monthly payment on the credit report, then the VA underwriter may require that you qualify along with that payment because it's being reported on your credit report. When it comes to negative credit events, here's what VA will allow you to do. So if someone went through a foreclosure, you are eligible for VA financing again after 2 years from the completion date of that foreclosure. Now, if someone went through a short sale or a deed in lieu of foreclosure, they will consider financing again as early as 12 months. However, it is subject to underwriting review. So they are going to analyze what happened after the fact. Did we establish positive credit accounts, or are we following negative behaviors and now showing new collections and non-payment? So you can do it as early as 12 months, but they are going to take a look at what happened after the fact. Did we demonstrate a better ability to repay per se? When it comes to bankruptcies, a Chapter 7 bankruptcy, you are allowed to get another VA loan after a 24-month period from the discharge date of the bankruptcy. Chapter 13 works very similar to FHA loans that we've talked about in the past. If you haven't watched that video, take a look at the section of our library here that talks about FHA loans to get a full breakdown. But VA also allows a veteran to buy a home while they're in the Chapter 13 bankruptcy, as long as there's been 12 months of punctual payments and as long as the court approves it. So as long as the bankruptcy court approves it, the veteran has been paying on time for the last 12 months, you can still purchase a home with your benefit, even though the bankruptcy is not concluded. When it comes to interest rates, generally you're going to see a 15-year option and a 30-year option. And then depending on the lending institution that you work with, sometimes we can tailor the loan. So for example, the company I work for, if a veteran said, you know what, Jorge, I would love to pay off this home in 25 years. Can I just get a 25-year loan? Well, yes, sir, you can. We do have the ability to tailor the loan to the term that you want, which is a pretty cool thing. Generally, the interest rate will be lower than an FHA loan or a conventional loan, which is also a good thing. And VA does allow the use of temporary buy-downs, 3-2-1. So for example, if the going rate were say 6% and through a seller credit negotiated by your real estate agent, if they were able to negotiate a big enough credit, then for the first year, you would get a 3% discount to the rate, meaning you start paying at 3%. And then for the next 2 years, you'll rise by 1% until you reach the 6% max. And right now, in a rising interest rate environment such as this, the temporary buy down becomes a very, very good option because it allows a veteran in this case to buy with reduced monthly payments, reduced rates for a period of 1, 2, or 3 years. It just buys you some time for when rates eventually fall, because they always do. Markets go up, markets go down, but this serves as a great bridge to get us through the rising interest rate environment. When it comes to mortgage insurance, one very big highlight with VA loans is that VA loans do not come with monthly mortgage insurance, which is excellent because a veteran's monthly payment may be $100, $200, $300 less per month compared to a non-veteran because there is no monthly mortgage insurance. However, VA does charge a VA funding fee. So let's take a look at that breakdown. So for a purchase, if the veteran is giving 0% down and it's the very first time that they're using their benefit, they will be charged a 2.3% funding fee. Now, the nice thing about this funding fee is that VA does allow you to finance this into your loan if you choose to, so you don't have to pay it out of pocket. Now, if the veteran has already used their VA loan and then they're reusing it again a subsequent time, then that funding fee does go up to 3.6% if we're giving 0% down. However, if a veteran chooses to give a down payment, which is completely optional, here's what changes. So if a veteran does 5% down or more, the first time use and the subsequent use is at 1.65%. So you get a break on the funding fee that VA charges. You get a further break if you do 10% down, which again is optional. If a veteran did 10% down or more on the first and subsequent use, now the funding fee is 1.4%. Now, please keep in mind, this is based on the 2022 year. This is something that VA analyzes and could be subject to change down the road. Now, when it comes to the funding fee for a refinance, here's what that looks like. If you're doing a cash out refinance and it's the first time that you use your VA benefit for the cash out, then now you're looking at a 2.3% funding fee. If it's a subsequent use, then now you're looking at a 3.6% funding fee, again, rolled into the loan. If you're looking at doing a rate reduction in order to just reduce your monthly payments, then now you do get a break on the funding fee and it's only a 0.5%. Now, another key thing with VA loans is this, that there is a VA funding fee exemption. So not all veterans pay a funding fee. Veterans with service-connected disabilities have an exemption and aren't subject to the funding fees we just discussed. A disability is generally a rating of 10% or higher. So if you're a veteran that was separated from service with 10% or higher in disability, it's very likely that you will not have to pay a funding fee, which is great. It's further savings for you. No need to finance that into your loan. Now let's talk about the allowed property types. VA loan will allow you to purchase a primary residence. They want you to occupy it for 12 months. They will also allow you to purchase a 1 to 4 unit home. So it could be a single family, a duplex, a triplex, a fourplex. If buying 2 to 4 units, VA does allow the use of rental income to help you qualify, which is great. You can buy condos as long as they're allowed and approved by VA. So if you wanted to find out whether the condo you're interested in is approved by VA, this is where you go to your lending institution, your loan officer, and we look this up for you and we can tell you what condos are eligible in your area for VA financing. VA also does allow manufactured homes. And if you notice here, I've made a comment, even if they are moved. Generally, a manufactured home is built in one place and then transported to the site where it sits. Every now and then, that manufactured home may go from the dealer to the site where it sits and then to another site where it gets moved to. A lot of the times when lending institutions see that, they don't like that. But veterans, because of their VA loan, if that manufactured home has been moved to a secondary location, VA is okay with doing that. And there are things that we check for you to make sure that the home is in good shape. That we're going to check the foundation. We're going to send an engineer over there to make sure that it's structurally sound for the veteran. Now let's talk about the loan limits. So loan limits are reviewed annually, but they are no longer per county. So if you watched our FHA video, FHA determines the maximum loan limit per the county that you're purchasing in. And there was a time where VA did the same thing, but now they follow the conforming loan limits. So if you're buying a 1-unit property, $647,200 is the max you can finance. 2 units is $828,700. 3 units, $1,001,650. 4 units, $1,244,850. However, there is a really cool, unique thing with VA that is called a high balance option for purchase. So this is really, really great for veterans. So if the home you fall in love with happens to go above those conforming loan limits, there is this high balance option for purchase as follows. So as long as you are $1 above the conforming loan limit, you can go up to $1 million with 100% financing, which is pretty awesome. It gives you a lot of flexibility. Now, if you're wanting to buy above that, there are a few changes as follows. So you can buy up to 1.2 million. However, now they're going to want you to come in with a 5% down payment on that VA loan, and they're going to require that you have a 540 credit score for the high balance option. If you wanted to purchase above that, you could go up to 1.5 million, but now the down payment requirement does go up to 10% down, and they are going to want you to have a 7 credit score requirement. Now, if 1.5 million wasn't enough and you want even more, you could go up to 2 million, but there is a 10% down payment requirement, and they do want a little bit of a higher credit score of 720. So this is a really cool, unique feature that VA gives you with the high balance option. Now, the high balance option is also available for a cash out refinance as follows. So you can borrow up to $823,375 with the max loan to value of 90%. So that's really cool in case you wanted to do a cash out refinance and exceed the conforming loan limits. Now let's talk about the appraisal and property condition. The appraisal must be completed by a VA appraiser. The property must meet VA minimum property requirements. And here's some of the common things that could be called out for. Defective construction, if there was any modifications to the home and they don't look like they were done in a good fashion or a safe fashion, that's going to be a challenge. Poor workmanship, evidence of continuing settlement, excessive dampness, leakage, decay, and termites. Now, when it comes to termites, one requirement that VA does have is that you must have a clear pest report. So at the time of purchase, going through a VA loan, your real estate agent will have a pest inspection completed. And if that pest inspection does not pass and come through as clear, you can expect for VA to come back and say, wait a minute, we need these items addressed. They are going to want to see a clear pest inspection. Now let's talk about the well and water quality. So when it comes to these things, what VA wants us to verify is whether it's capable of providing a continuous supply of safe and potable water. They may do a water quality. The water quality must be approved by the local and state health authority. So every now and then, if the well does not pass the water quality test, there are certain things that you can put in place, like a reverse osmosis system, in order to make the water now safe according to the local state health authority. Now let's talk about a really unique thing with VA, which is called the VA Tidewater Policy. This policy exists to combat low appraisals because ultimately an appraisal is an opinion of value. So if the Tidewater Policy is invoked, what happens is the appraiser then notifies us, the lender, letting us know that it's very likely that the appraised value will fall below the purchase price. When this happens, they do give us a window of opportunity to reach out to the real estate agent and request additional comparable sales. As long as we can justify the sales price written in the purchase agreement through additional comparable sales, then the appraisal could come back in at value. Or if we cannot justify the value, then we will get the appraisal and then we will find out, whatever the price is, the price is. Normally when this happens, that's when your real estate agent goes and negotiates on your behalf to try to come with an agreement should there be a lower appraisal. Now let's talk about employment. Generally, they want to see a 2-year employment history. This demonstrates stability. It can be with multiple companies. However, we want to make sure that we explain why there's consistent changes. Was your job improving? Were you getting paid more? Are you getting paid more per hour at the next job? Are you getting better benefits? So if there's multiple companies, we want to make sure that we explain clearly why this is happening. Ideally, we want it to be in a similar line of work. And if there are employment gaps, there is going to be questions. So as a general rule, if you've been out of work for more than 6 months, it's highly possible that a VA underwriter may come back and want you to be back at work for 6 months, unless there's some sort of extreme extenuating circumstance. When it comes to the debt to income ratios, VA is very, very flexible. So generally, they want the housing ratio at 46.99%, and generally the back end ratio at 56.99%. Now, when I say generally, I mean that. VA has an underwriting system. There's actually a couple underwriting systems, Loan Prospector and Desktop Underwriter. And when we run these systems, depending on the overall credit score, credit profile, employment history, every now and then, the underwriting system may surprise us and allow for much higher debt ratios than listed here below. So that's why I emphasize on generally, because if the system gives you more flexibility, then you're okay to proceed with that. Now, when it comes to a high balance, the maximum debt ratio is a little bit different. You are going to be limited to 55% debt ratio with AUS approval. The AUS approval comes from the systems I just mentioned, Desktop Underwriter, Loan Prospector, which are systems that we run on our end in order to make sure that you qualify. Now, if you're wanting to borrow $1.2 million and greater, then the debt ratio does come down quite a bit, and now they're going to limit you to 45% debt to income ratio when you're borrowing that much. VA also allows for what's called manual underwriting. So every now and then, if the decision engine does not issue an approval, that doesn't mean you can't get a loan for a VA, but now you have to go through this manual underwriting process, and here's those requirements. So you will be limited to a 41% max debt ratio unless there is 120% residual income, which I'll explain about more in a little bit. They are going to want to see acceptable verification of rent to prove that you're consistently paying rent on time. If someone doesn't have credit scores, VA does allow the use of non-traditional credit scores in order to demonstrate the ability to repay. So an example of non-traditional credit would be proof that you've been paying your rent on time for the last year, proof that you've paid your auto insurance on time, your renter's insurance, these kinds of things. Reserves can also be used as a compensating factor in case of excessive payment shock. And what payment shock refers to is if you're currently paying rent at $2,000 a month, but you're trying to now purchase a home and your payment is going to $3,000 a month, that's payment shock. So reserves can be used as a good positive factor to offset that. So now let's talk about seller contributions, which are allowed by VA. Now, it is often thought that veterans are limited to a 4% seller contribution, which is inaccurate. However, there is a 4% rule that VA has, but let's talk about what that 4% max applies to, because it's only to certain charges. So the charges that 4% rule applies to is the VA funding fee, prepayment for property taxes and insurance. Let's say you're trying to prepay a year's worth of property taxes. It is allowed, but then now you're subject to that 4% rule. Extra points to provide either a permanent or a temporary interest rate buy down. And one that many people don't know of is paying off credit card balances or judgments on behalf of the buyer. Yeah, you heard that right. VA will actually allow a seller to pay off a liability to help them qualify, which is pretty amazing. There's no other loan program that allows you to do that. But if a seller decides to do that and help pay off a credit card or a judgment in order for the veteran to qualify, then you're subject to the 4% rule. So in a nutshell, there's really no maximum seller contributions for a seller's closing costs as long as it's your traditional closing costs and as long as it's only being used for the closing costs. So for example, if a seller wanted to give you $20,000 in closing costs, but the closing costs were only $15,000, you can't get the difference. That money can only be used for true actual closing costs being charged. Now let's talk about refinancing with a VA loan. VA comes with this really unique option called the VA IRRRL, which stands for Interest Rate Reduction Refinance Loan. Now, in order to be eligible for a VA IRRRL, you must have a VA loan currently. So if you bought a home with a conventional loan or an FHA loan and then became an eligible veteran and tried to refinance through an IRRRL, you can't do that because your current loan must be an existing VA loan. Now, if you're one of those that purchased with your VA loan, then yes, you are eligible for an IRRRL, and here's the benefits of that. So one benefit is there is no credit score. Your credit report is not checked. There is no debt ratio requirement because your credit score is not being checked. Your credit's not being run. There is no income requirements. Your income doesn't matter doing an IRRRL. And there are also no value requirements, so it does not matter what your home's value is. And the logic behind this is if you're already performing on your VA loan and you're paying on time and haven't missed a beat, then it's very likely that if we're dropping your rate, dropping your payment, you will continue to perform on the loan, which is great. You don't have to go through the hoops of qualifying on your income and your credit in an appraisal through the IRRRL. So this is an excellent option for those of you that have VA loans. Now, VA does allow a cash out refinance as well. However, there is a seasoning requirement, and that requirement is that the note date must be 120 days from the first payment and 6 monthly payments made on time in order to pull the cash out on that home. Now, you are limited to 90% max loan to value, which must include your funding fee. So this is something that we'll calculate for you. If you are subject to a funding fee, that funding fee, once it's financed, we have to keep your loan to value at 90%. Now, this is something that's changed. There was a time where VA would allow you to access 100% loan to value on the property, but over the times, as markets change, as risk changes, then VA lowered it to the 90% max. Now, something really unique with VA is that VA will actually not allow a cash out on a home that's free and clear, which is something that's really unique. So if you own your own home free and clear and you want to use your VA benefit for a cash out, you actually can't. The property must be liened. So one simple workaround is if you end up getting a line of credit, a home equity loan on it, then now as long as there is a lien on the property, you're eligible to do a cash out refinance on a property owned free and clear. Now let's talk about some additional VA requirements, because VA is in its league of its own when it comes to analyzing risk. So it does have a few things that it considers versus other financing types. So one is that the veteran must have a certificate of eligibility. This is what determines whether you're eligible and how much entitlement you have on your VA benefit. Some veterans have a copy of this. If you do not have a copy of this, do not worry. As an approved VA lender, we can actually enter your information through the VA portal in order to help you get a copy of that. Now, there is this requirement of residual income per region. So depending on the amount you borrow, if you borrow under $80,000, there's a set amount of residual income required. If you borrow over $80,000, there's a different set amount required for residual income. And another factor too is your family size. So depending on your family size and depending on the region you purchase in, there is a set number you must have in residual income in order to stay approved with the VA loan. And this is something that we look up for you at the time of approval. One unique thing that VA does is that they do factor maintenance and utilities. And the way that they calculate this is they use 14 cents per square foot to factor for future maintenance and utilities. So if you have a 3,000 foot square home times 14 cents, and then the result of that number is how much will be factored in your residual income calculation. One really unique thing with VA is the flexibility on student loans. So if your student loan is going to be deferred 12 months past the closing date of your purchase, then there's nothing more needed to be done on that student loan. It can just be excluded. It doesn't affect your debt to income ratios. However, if it is going to start repayment within that 12-month period, then now the simple calculation they're going to do is 5% of the outstanding balance divided by 12 months, and we'll use that as the monthly payment to hit your debt to income ratios. But this calculation is rather low, so it really many times has not a big effect on a veteran's ability to qualify. One thing to point out with VA loans is if you're purchasing in a community property state such as California or Nevada, which is where I reside, if the veteran is married and they're applying by themselves, if they are married, community property states will require that we check the spouse's credit, and whatever liabilities come up, let's say a car loan and 2 credit cards, even though the spouse is not on the loan application, because it is a VA loan and because they are married, we have to add these liabilities into the debt to income ratio calculation in order to qualify. Now let's talk about what a seller thinks when it comes to VA loans. So oftentimes it's thought that it might be a riskier loan compared to other loans because of the fact that it's 100% financing. But in my opinion, it's one of the best loans out there. There's many veterans that are very well qualified, and most of them are going to have lower payments compared to everybody else because they're not subject to mortgage insurance. So in my opinion, they represent not a higher risk, but actually a lower risk. It is mistakenly believed that a seller will have to pay all of the buyer's closing costs, which is simply not true. A few slides back, I shared an example of some of the fees that that a veteran is not allowed to pay, but some of those fees may not apply in the state that you are purchasing in. That being said, how do we apply for a VA loan? Do I just call the VA, Veterans Administration, and ask for my VA loan? Well, that's not how it works. What we want to do is we want to talk to any lender or lending institution that is approved by a VA loan, such as yours truly, in order to get the process started, find out what your eligibility is, what you qualify for. This way you can continue your home journey with your VA loan.